Welcome everyone on this webinar on understanding the popular technical indicators. So in this webinar, we will be covering these topics. One is first one is, do indicators help you analyze markets better? Second is that trend following indicators. What are the trend following indicators? Moving averages, and what are the moving averages? What is ADX? What is MACD? Then what is Ichimoku, or again a super trend? So I'll be talking about them, and apart from that, I will be talking about oscillators, oscillators such as stochastics, RSI, and Bollinger Bands. And lastly, I'll be talking about how to identify high probability trades with trending and non-trending indicators. So this will be the structure of this webinar. So the first is that, do indicators help you analyze markets better? What we need to understand here is that if you look at this particular chart, here we don't have any indicators, so it's very difficult for you to make out anything out of this, except that these are candlestick patterns. So if you understand them, then maybe you could have some idea. But otherwise, you can't make much out of this. This is a Nifty daily chart, and indicators, they act like a compass. So at the C. So here we have the Nifty again chart, and this is an latest chart, wherein you can see that we've seen some selling happening in Nifty, and there are many indicators which are plotted. So I'll be covering most of these popular indicators and explaining to you how you can help use it well. So I will be talking about each of the indicators in detail. So you can see from this chart that indicators act like a compass. So if you look here, this is a major support. The markets have bounced back. This is a weighted moving average, 180 period weighted moving average. You're seeing that. Then you have other moving averages. Then you have this MACD histogram is there. That's negative. Then you have this stochastics. Then you have EDX. So I'll be talking about most of the popular indicators, how you can use them to your advantage. So these are the indicators which I'll be talking about. First, I'll be talking about the trend following indicators. That if there are two types of indicators, basically trend following indicators and counter trend indicators or non-trending indicators. So ideally, the best strategy is that if the markets are trending, then you use a set of indicators. If the markets are non-trending, you use another set of indicators. So we'll be in trend following indicators. I'll be talking about moving averages. I'll be talking about ADX. I'll be talking about MACD. I'll be talking about Ichimoku Kinko Hyo, and I'll be briefly talking about super trend as well. There are hundreds of indicators. So you can explore other indicators. If you have queries, you can write to us at webinars@theheatherateengelbooking.com. So coming to the moving averages, this is one of the most versatile and widely used of all technical indicators. Because of the way it is constructed and the fact that it can be so easily quantified and tested, it is the basis for many technical trend following systems in use today. So moving averages, all of you must have heard about moving averages. So moving averages are of different types. You have a simple moving average, you have something called the exponential moving average, you call the volume weighted moving average, then you call the weighted moving average, then there are many types of indicators. So moving average, so there are systems, trend following systems, which use moving averages when today, and they have their own rules and which can be easily programmed into computers, which generate specific buy or sell signals. So it's called a moving average because it is an average of a certain body of data. For example, if a 10-day average of closing prices is desired, so the closing prices for the last 10 days are added up and the total is divided by 10. Now the term moving average is used only because only the latest 10 days prices are used in the calculation. So 1 till 10, so we'll have that. On 11th, you skip 1 and it becomes 2 to 11. So effectively you have 10 days data. So that's the reason it's called moving. So it keeps on moving. Now generally two are most popular, the simple moving average also called the SMA, and the exponential moving average also called the EMA. So the SMA simple moving averages are more suitable for long term. So you can use a 100-day period or 200-day period simple moving average on long term charts, daily charts, or any time frame. You get a very good idea as to how the markets are, what the trend is of that particular stock or index, whatever, or whatever you're looking at, be it a commodity currency, whatever. The second is EMAs, exponential moving averages. Exponential moving averages, they are more suitable for a short term. So if you want to know the short term trends, then you can use a 10 period. If you want to know medium term trend, then 30 period and 50 period and 65 period. These are very good for using exponential. So you will come to know exactly. So the medium term is also called the intermediate trend. So intermediate trend ideally is 50 and 65, but even a 30 period is very good for you to understand what the overall trend is, because if you look at the 30 period, so that's roughly 1.5 months of data, 20 trading sessions, so 1.5 months of data. So that also is a good average. A 10-day is an excellent, a 10-day exponential moving average is an excellent indicator of short-term movement. So the simple moving average is best for long-term. The exponential moving average is best for short-term. And most important, it is not that the prices are closing out with the moving average or closing below the moving average that is important. What is most important is the slope of the moving average. That is important. You have to look at the slope of the moving average. If the short-term slope is up, then you should be on the any dip should be used as a buying opportunity if you're trading from a short-term perspective. Likewise, if the short-term trend is down, then you should be any pullback should be used as a shorting opportunity rather than as a buying opportunity till the time you find some major support or some valid technical reason to buy. Next, so I talked about moving average. Next, we look at another indicator, that's ADX. ADX is something which is it's an excellent trend strength indicator. This I pulled up hourly chart of Nifty, and you can see that Nifty is, if you look at the ADX, I'll talk about that. First of all, let's understand what it is. So ADX is an excellent trend strength indicator. Moving averages are basically give you the direction of the trend, but whether the trend is strong, whether the trend is weak, that an ADX can tell you. But ADX at times is something I would say confusing also. So I'll talk about that as well. So ADX calculations are based on a moving average of price range expansion over a given period of time. So generally the ADX, the parameter here is the default is 14 period. Although other time periods can be used, but generally world over most popular is 14 period for ADX. So ADX is plotted as a single line with values ranging from a low of 0 to a high of 100. And ADX is non-directional, means that even in an uptrend, the ADX will move up. Even in a downtrend, the ADX will move up. So it's non-directional. So it's not that it will go down in an uptrend. It's that way. It registers trend strength whether price is trending up or down. So if it is sloping up, that means the trend is strong, be it a uptrend or a downtrend, and the indicator is usually plotted uh, in the same window as the two directional movement indicators DMI lines from which ADX is derived. So when we look at ADX, we have three basically parameters or three outputs are here. One is the plus DI, the second is the minus DI, and the third is the ADX line. So there are three lines which are formed. So when the plus DI, if you look in this particular chart, so the plus DI is represented by a green line. The minus DI is represented by a red line, and this gray line is the ADX line, and this horizontal I have put as 20 here. So what effectively it means is that if the green line, that is the green line is plus DI, so when plus DI is above the minus DI, prices are moving up, you can see. and the ADX measures the strength. So here you can see that ADX has started moving. So here the strength is there. So prices have moved up significantly. When the minus DI is above plus DI, if you can see here, what's happening here is that the red line is above the green line. So the red line is the minus DI, minus DMI. That is minus directional movement index. Above the plus directional movement index, that means the overall trend is down. And here you can see that the ADX value is, if you can look at the horizontal here, it's 20, 40. So the ADX value is increasing. So you can see that there has been a very sharp correction in the Nifty. And then you can see that again ADX has reached 50 plus, so that's an extreme reading. So from there the Nifty has bounced back. So if you can understand some of the readings, if you can remember some of the readings, that can be very helpful and very effective. So what many traders do is that when the ADX value is more than 25, that suggests that the trend is strong, and that is a good time for trend trading strategies. Conversely, when the ADX is below 20, many will avoid trend trading strategies. So you'll find that that's not a good time for you to have trending strategies. So it's more for trendless markets. So their oscillators will be more useful. So ADX is a very good tool, and what all I am explaining is the basics. If you really want to understand it further, but I'm telling you some of the key areas which you should focus. Any ADX value above 50, you should immediately be cautious. That means that it's a overheated market, so the market could correct. So if the market has witnessed a correction, that means the market could pull back, and if that is a major support level, then that becomes all the more possible. But the pullback can be temporary because still we are seeing that it is the red line which is above the green line. So next we look at another indicator, that's the moving average convergence divergence. That's also called the MACD. MACD was developed by a person named Gerald Apple. What makes this indicator so useful is that it combines some of the oscillator principles with the dual moving average crossover approach. When I was speaking about moving average, there's something called the moving average crossover, wherein we have two moving averages, a short term and a long term. So when the short term crosses the long term from below and moves up, that's called a moving average crossover. So that's a buy signal. Likewise, when the short term moving average crosses the long term from above and goes to and both slope down, so that's a sell signal. So what an MACD does is that it combines some of the moving average crossover approach along with the oscillator approach. So in this case, there are two lines. We have the faster line, which is called the MACD line. So here the parameters are generally 12. You can see here parameters are 12, 26, and 9. This ideally you should use these parameters. Many times you'll find that when you're plotting MACD histogram, you're not looking at the parameters, but it is the parameters which is the key. Because in some applications, the parameter, the default can be 13, 9. So you won't get the proper signal. So the most popular are 12, 26, and 9. Just like for ADX, the parameter that you should look at is 14 period. Likewise for MACD histogram, the parameters are 12, 26, and 9. So the faster line, which is called the MACD line, it is the difference between two exponentially smooth moving averages of closing prices. So generally the 12 period and the 26 period. So this MACD line, which is called, so it's also the faster line. It is the difference. It is the difference between these two exponentially moving averages, that is 12 period exponential moving average and the 26 period moving average. Or if you're using hourly charts, then it becomes a 12 hour and then a 26 hour. And you can apply, the best part is all these indicators you can apply even on a 5-minute chart to as long as a monthly chart as well. So the next is apart from the faster line, which is called the MACD line, you have the slower line, which is called the signal line. So is usually a 9-period exponential average of the MACD line. So the MACD line is a faster line that is again smooth, making it a 9-period exponential average of the MACD line. So that becomes a signal line. And Gerald Apple originally recommended one set of numbers for buy signals and another for sell signals. However, most traders utilize the default values of 12, 26, and 9 in all instances. That would include daily and weekly as well. It would also include monthly, hourly, 15 minutes, 10 minutes, whatever. So what happens here in the MECD histogram? So we'll just look, I'll talk about this here and then I'll look at the MECD histogram and explain to you the picture so you'll get a better. So the two lines, MECD histogram. So what you have is a MECD line and a signal line. So the two lines, MECD lines, can be converted into an MECD histogram. So the MECD histogram, the histogram consists of vertical bars that show the difference between the two MACD lines. So as I talked earlier, we have the faster line called the MACD line and the slower line called the signal line. So the difference of this is plotted as an histogram. So you can see here the histogram consists of vertical bars that show the difference between the two MACD lines. So the histogram has a zero line of its own. When the MACD lines are in positive alignment, that is faster line over slower line, the histogram is above its zero line. So crossings by the histogram above and below its zero line coincide with the actual MACD crossover buy and sell signals. So in this case, what will happen is that the buy case, the faster line will cross over the slower line and move upward, whereas in the sell signal it will go downwards. So the real value of a histogram is spotting when the spread between the two lines is widening or narrowing. So when the histogram is over its zero line, positive, but starts to fall towards the zero line, the uptrend is weakening. Histogram turns are best used for spotting early exits from existing positions. So now if you look at this will give you a very good idea. So you see this particular chart, what here is a histogram. This is a daily chart of Nifty. So you can see that the parameters are 12, 26 and 9. And this you can see that this horizontal line is the zero line. And anything above the zero line is positive, anything below the zero line is negative. So once the histogram moves to the positive and then it starts moving up, so that means the trend is positive, means that the trend is up. But if each and every bar is starts increasing, that means the trend is very strong. But here you can see what has happened is that the slowly and slowly the bars have become smaller and smaller. So what's happening, the price is again trading in a range. But here again what has happened is that bars have started becoming stronger. So you can see that once this breakout was there, it started rallying. But just look at this, the recent fall that we have witnessed, the fall that was there. Prior to that, only MACD histogram started declining. So it made a peak and then it started declining over the last few days. So last week itself. So you can see that it started declining. So that's a warning signal. If you can see what's written here is that histogram terms are best used for spotting early exits from existing positions. So if you're on the buy side, this is where you can use it to exit or at least book your profits and get out. So, or at least that gives you a warning that be careful, there could be some correction. Here, what has happened is that it gave you a warning, but prices did not correct significantly and again bounced back. But here again, what we are seeing is that again it's the same story, increased and then started decreasing, and then all of a sudden, last 3 days started there was some major correction, and then we can see for that. So overall, in whatever time frame you use, whenever you use MACD histogram, is basically it's an X-ray. It gives you a very good idea as to the trend strength. I have mentioned here is that just like an ADX is an excellent trend strength indicator, MACD histogram is also an excellent trend strength indicator. So you should use MACD histogram, and it is confusing at times, so you have to be careful. And also you can look at divergence in this. I'll just give you an example here, that you see that this low is lower than this low, but the low of the MACD histogram, this low is higher than the low of this. So this becomes a bullish divergence. So prices are making a new low, but MACD histogram is not picking a new low. So then from there only the markets started rallying. So this is a bullish divergence. So you can use your MACD histogram for studying this as well, as to whether it's bullish divergence or bearish divergence. So that gives you a very good idea and very good clue. So because the extreme readings, if that is there, so you can that means that you have to be extremely cautious somewhere. And here you can see that the trend is every day it is increasing. So overall the prices are also strong, and then they've started declining here. So that's clearly a warning that now you have to be cautious. At least you can be a trader, but not an investor at these levels. So that's the way technical. But only thing is you have to be rational while looking at it. So now we come to another indicator which is the Ichimoku Kinko Hyo. This is something which is very popular and used very well, and it is gaining in prominence, but people are not don't understand much about this. People find it to be complex, but it is not complex if you pay attention to how it works. So, as also known as the Ichimoku cloud, is a versatile indicator that defines support and resistance, identifies trend direction, gauges momentum, and provides trading signals. So, there are two ways to identify the overall trend using the cloud. The trend is up when the prices are above the cloud, and down when the prices are below the cloud, and flat when the prices are in the cloud. So you can see here that this cloud, it is default. I'm using its green color, so that means the overall trend is up. So, and this is red color, it means the trend is down. So you have to be slightly cautious here. And then you see here what has happened is that this prices have corrected. This again Nifty prices have corrected. They have come to the lower end of the cloud, so which is acting as a very strong support. If you look here also, this is the lower end of the cloud. So the lower end of the cloud or the upper end of the cloud, they will act as very strong support. The lower end is very strong support, and the upper end has very strong resistance. So if the overall trend is down, and the stock or the index has moved towards the upper end, and but it's not able to close, and there is a bearish Japanese candle formation also, or some bearish divergence which you see, so that can be a very good shorting opportunity. Likewise, if overall trend is positive, and the stock or index has come close to or almost to its lower part of lower band of the cloud, that can be a very good buying opportunity, provided the overall trend is positive. So if you are looking at the daily charts, entry and exit, then you should look at the weekly charts to identify what the trend is. Likewise, if you are entering or exiting on an hourly chart, then you have to look at the daily chart for the overall trend. So a larger time frame is required to be looked at for trend identification. So in this case, what happens is that as I talked about, that when prices are above the cloud, that's a bullish sign. When prices are below the cloud, that's a bearish sign. When prices are inside the cloud, that means it's a flat market. Secondly, what happens is that uptrend is strengthened when the leading span A, that is the green cloud line, is rising above the leading span B, that is a red cloud line. This situation produces a green cloud. What you need to simply understand here is that this green cloud, I'm just repeating it once again, that if prices are above the green cloud, that means the overall trend is positive. Likewise, a downtrend is reinforced when the leading span A, you can for the moment skip this, is leading span A, that is the green cloud line, is falling, and below the leading span B, that is a red cloud line. This situation produces a red cloud. So you can see here that we have a red cloud. So generally what happens is that if prices are below the red cloud, here what is happening that it is red, but overall the trend is above, so you don't go short. Here what's happening is that the overall trend is above the green cloud, and here prices have come, they have taken support, so this can be a very good buying opportunity. So what I would suggest is that you should definitely look at this. This is very good for helping you identify the trends, and also it will keep you on the right side of the trade most of the time. So if you look at the Ichimoku The bullish signals, what it means is that prices move above the cloud, then cloud turns from red to green. So if the prices are moving above the cloud, if you look at this figure, so here what was the cloud was red, but slowly it has turned green. So it means is that overall trend has again turned bullish, and prices move above the baseline. There are many lines which are there, but the major lines we have called the conversion line and the baseline. So conversion line in Japanese is called the Tanka-sen, and the baseline is known as the Kyun-sen. So so what you need to understand is that for bullish signal, price has to move above the cloud, and secondly, that this conversion line moves above the baseline. So in this case, if you look at it, the conversion line, this pink line which is moving above the baseline. So the trend becomes even more stronger. So you can start looking at this indicator also. This can be very good. Likewise, for a bearish signal, prices move below the cloud. That is, it is trading below, and price cloud turns from red to green. So from green to red. So what we are seeing is that earlier the markets were bullish, but now we are seeing that it is bearish. So the cloud has turned from green to red, and here again prices move below the baseline. That is below the baseline, and here the conversion line moves below the baseline. So again, in this case, what happens is that the conversion line will move. If you can look here, the conversion line, this pink line has moved below the a green line. So it means is that you have to be cautious on the buying side. But here, since it is above this cloud, so it does not mean a sell opportunity. But in this case, what we are seeing is that this pink line here is below this green line, and here the pink line crosses the green line, and also it is above the cloud or somewhere around the eye of the cloud. So this can become a very good buying opportunity. So you can start with this. First of all, look at the clouds and look at the two lines, that is the Tankas sen and the Q sen, which can really help you understand the trend even better. So with this, we've concluded the talk on the trending indicators. Apart from that, there's something called super trend also. So super trend is also an indicator which basically uses average to range, and it is plotted. It's very simple that if prices close above, we have then uptrend. If prices close below, we have a downtrend. But it is also the slope which you have to look at. So, but more or less, they all work on the same principle. So if you follow this also, this gives you an Ichimoku, gives you a better perspective. It gives you help. It helps you identify strong support and resistance levels apart from the clearly identifying what the trend is. So if you are a long-term trader, then you should definitely look at the weekly trends and then move to the daily trends. So the weekly trend is positive. If the weekly trend is above the cloud, then whenever you get a buying opportunity on a daily chart, that means daily it's moved from a red cloud to a green cloud, and Tanka-sen is above the Q-sen, that can be a very good buying opportunity. So these are certain things which you can do, plan and do, and they can help you on a real-time basis. Also, if you are to take a trade, you can always cross-verify with these indicators. Always look at the indicators from a two-time perspective, not a single time frame. That means just don't look at it on a daily chart. Also go back and look at the long term, that is a weekly chart. Likewise, if you're trading on a 15-minute chart, then go and look at the hourly chart as to how's the trend on an hourly chart. So if the hourly trend is up, then only you should take a buy signal. Likewise, if the hourly trend is down, then only you should use a sell signal. But if the hourly trend is down and you are using a buy signal, so the possibility of you making money reduces significantly. So always go with the higher time frames trend. Next, we look at some of the oscillators. We'll be covering stochastics, RSI, Bollinger Bands. So I'll be talking about them as well. So oscillator, this is an extremely useful in non-trending markets. The prices fluctuate in a horizontal price band. So generally, markets are there in three frames. One is an uptrend, that is prices are moving up. Second is downtrend, prices are moving down. And third is a sideways trend. and it's been found that close to 65 to 70% of the time the markets trade in a sideways zone. So in sideways markets, or using oscillators can be very good for buying and selling opportunities. Also, if you look at the value of the ADX, if the value of the ADX is below 20 and it's flat, so that also means that the overall trend is down, the overall trend is flat. So in that case, oscillators can help you enter and exit very well, because it works extremely well in trendless markets, but fails significantly in a trending market. So many a times, if the trend is very strong, you'll find that the oscillator reading is very high, it's maybe 80, 90, and you'll feel that the market should correct because it's an overbought territory. But still, the market or the stock is not correcting, index is not correcting. Why is that? Because the trend is so strong, so the stock or the index can remain in overbought zone, that is above 80 or above 90 for weeks and months altogether. So just because some stock or some index has moved into an overbought zone does not mean that you should sell it, sell or book profit or go short. Likewise, just because the stock has moved into an overbought territory does not mean that you should simply go and buy that stock. You have to look at its longer time frame. So the oscillator is extremely useful in non-trending markets where prices fluctuate in a horizontal band, creating a market situation where most trend following systems don't work that well. A second is the oscillator provides a technical trader with a tool that can enable him or her to profit from these periodic sideways and trendless market environments. So that's one major advantage, that in these trendless markets, you can trade very well with oscillators, and used in conjunction with price charts during trending phases. The oscillator becomes an extremely valuable ally by alerting the trader to short-term market extremes, commonly referred to as overbought or oversold. So oscillators, you would have heard of overbought and oversold zones. So oscillators, basically it could be stochastics, it could be RSI. They all tell you about overbought and oversold zones. So I'll be talking specifically on stochastics, but RSI also works on the same time, on the same in the similar manner. If you're comfortable using RSI, you can use RSI. If you're comfortable using stochastics, that's even better. I personally prefer stochastics because that's more smooth, and the signals also are comparatively fewer and fewer. So that's one of the reasons. So this oscillator was popularized by a person named George Lane. It is based on the observation as prices increase, closing prices tend to be closer to the upper end of the price range. So if prices are closing on a daily basis, and if the trend is up, then prices generally close towards the upper end of the price range. Likewise, if prices are falling, then prices generally will close towards the lower end of the price range. So two lines are used in the stochastic process. We have the percentage K line and the percentage D line. So the percentage D line is the more important and is the one that provides the major signals. Now here again 14 is the most common period used for this oscillator. We saw that 14 was also the period most common period used for ATX. So here also you should be using 14 period. So to determine the K line, first of all, what is the K line, which is the more sensitive of the two? The formula is percentage K is equal to 100 multiplied by C minus L14 divided by H14 minus L14. So, so this is very simple. There's not much to talk about here. I'll just explain this. That percentage K is 100 multiplied by C minus L14 divided by H14 minus L14. So where C is the latest close, L14 is the lowest low of the last 14 periods, and H14 is the highest high for the same 14 periods. So generally, you have this value which comes. So you basically plot it on a daily basis. So you take the lowest low for the last 14 periods, the highest high of the last 14 periods, and the close of that particular day. And on that basis, you first do the close minus the lowest low of last 14 days, and that divided by the highest high of the last 14 days minus the lowest low of the last 14 days, and that multiplied by 100 gives you the percentage K value. So the result, the output that you get is simply measures on a percentage basis of 0 to 100, where the closing price is in relation to the total price range for a selected time period. So the total price range is what? High minus low, 14-day high minus 14-day low. So that's the price range. So and we are taking the close minus the low. So we are looking at where the close is in comparison to the selected time period, the total range. So a very high reading, so a stochastic having a very high reading, say over 80, would would mean that the closing price is near the top of the range, while a low reading under 20 means near the bottom of the range. So that's something which you can look at. And the second line, that is the percentage D, is a 3 period moving average of the percentage K line. So this formula produces a version called fast stochastics. So we have first the percentage K line, and when you average it out by a 3 period moving average, so you get a percentage D line. And by taking another 3 period average of by another 3 period average of percentage D, a smoother version called slow stochastics is computed. Most traders use the slow stochastics because of its more reliable signals. So these formulas produce two lines that oscillate between a vertical scale from 0 to 100. The K is the faster line while the D is a slower line. So you can see for yourself that the stochastic is a very good indicator for telling you whether the stock is in overbought zone or oversold zone, and if the overall trend is up, you can use it for a buying opportunity if it comes in an oversold zone. Likewise, if the overall trend is down but there has been a temporary relief rally and the stock moves in overbought zone, so that can be a very good shorting opportunity. So the major signal to watch for is a divergence between the D line and the price of the underlying market when the D line is in overbought or oversold zone. So the extreme and the upper and the lower extremes are 80 and 20 values. Some people use 70 and 30 as upper and lower values. You can also use 70 or 30 or 80 or 20. Now, what is important here is that uh, the if the stock or index is making a high, so what is happening to the stochastic? It's not making a new high. So this is more or less a bearish divergence, so means that there could be some selling pressure or you have to be cautious. So then there is a possibility that they could, so you can use other indicators like support, resistance levels, your candlestick patterns, and your MACD histogram divergence. So using a combination of these indicators can really help you understand even far better as to how the market is likely to perform or the stock is likely to perform. Next, we look at, and the similar is with RSI. There is a relative strength index that also plotted the same way. It also works on the overbought, oversold zone. So, if you are interested in RSI, you can further go ahead and study about it. But both are the same. You can use either, but stochastics, as I said, is far smoother and more reliable because it is comparatively slow. So you can use this. The other indicator which is of good use is the Bollinger Bands. So Bollinger Bands, this was developed by John Bollinger, and here what happens is that two trading bands are placed around a moving average, similar to the envelope technique. So except that the Bollinger Bands are placed two standard deviations above and below the moving average, which is usually 20 days. So in this case, what happens is that in Bollinger Bands, you use the time period parameter is 20 and the standard deviation that you use is 2. So in this case, what happens is that when you're using so what you get is you get an upper band and a lower band, and you get a middle line. That is a 20 period average. So using two standard deviations ensures that 94 or 95% of the price data will fall between the two trading bands. So the benefit of Bollinger Bands is that in 95% of the price data will be within the upper band and the lower band, and generally you have to act or react only when if the price moves above the upper band or if the price moves below the lower band, that's the time you have to become active. So as a rule, prices are considered to be overextended on the upside, that is overbought when they touch the upper band, and they are considered overextended on the downside, oversold when they touch the lower band. So the simplest way to use Bollinger Bands is to use the upper and lower bands as price targets. So if you're buying anywhere in the band, you can use the upper band for a buy target, and if you're on the sell side, the lower band as your price target. During a period of rising price volatility, the distance between the two bands will widen. So generally what happens is that if there is a high volatility in the stock or in the index, the band will become very broad. That means the band will widen and will become very broad. Likewise, in the period of low volatility, the distance between the two bands will contract. So we will look at an example. But before that, I would like to cover this part. So when the bands are unusually far apart, you can see that the bands are unusually far apart. So it effectively means that the current trend may be ending. So there is a possibility that the current trend could end. When the distance between the two bands has narrowed too often, that is a sign that is often a sign that the market may be about to initiate a new trend. So that means that there could be a trend in the market. So when the bands collapse and when the bands narrow down significantly, that means the price or the stock or the index is least volatile. So if there is a breakout, there could be a major move in that particular stock or index. But only what happens that Bollinger Band does not tell you in which direction the move will happen. For that, you'll have to use other indicators and also wait for a breakout. So Bollinger Bands can also be applied to weekly and monthly charts by using a 20-week and 20 months instead of a 20-day. So if it works, the best part is technical indicators and technical analysis works across time frames. So it works well on 15-minute chart, 5-minute chart, hourly, 2 hourly, 4 hourly, daily, weekly, monthly, whatever. So that gives you an advantage. So if you look in this particular case, what is happening here? We've seen that prices have corrected. Here the price has closed. This is the lower band, the red band. This green is the upper band. So prices have closed below the lower band. The next day prices opened somewhere here, made a low, but closed above the lower band. And if you can see this, so what is here? It is in oversold territory. You can see this is 20 period here, so it is below 20. So this is in oversold territory. You have a Bollinger Band period, and then from there has been a rally. This again is the chart of Nifty. So you got some good signal here that Nifty is closed like this. So, but this is a daily chart, so you get few signals. But if you're looking at hourly chart, 30-minute, 15-minute chart, you will get more signals. So the longer the time frame you see, the smaller the fewer number of trades you will get. So if you're looking at a weekly chart, you might get trades, but that would be very few and rare. Likewise, short-term trading, you can look at a 15-minute, 30 minutes, or an hourly chart, and you can trade. If you look here, what has happened is that again it has closed above the upper band, and then it has consolidated here. Here also it has closed above the upper band. Next day there's been a gap up, so more or less markets have moved up, but then again they've been picking up somewhere here. So Bollinger Bands are something which are very useful. You can use it to your advantage. So now I'll be talking about how to identify high probability trades with trending and non-trending indicators. So I've talked about the major indicators such as moving averages, MACD histogram, then Bollinger Bands. I've talked about EDX. I've talked about Ichimoku. I briefly touched upon your stochastics and also about super trend. So I think there are many indicators, and you can use any of them. I would say at least use two to three. Anyone I would suggest is use at least three indicators. They all should confirm. That gives you a better opportunity. So if you look at this a Nifty daily chart, you can see for yourself what has happened here. That prices have closed below the lower band, then price close above the upper band, and this is a 100-day moving average. This yellow line. So you just look at it. This 100-day moving average, so it has first closed below the 100-day moving average, then it has closed above the 100-day moving average, and it has closed below the band, closed above the band. This is in oversold territory, and then you have this MACD histogram is negative. Next few days, MACD next few days after that MACD starts declining somewhere here. So that means that's a very good opportunity. If you look here it has moved in oversold territory, but you not got this signal. That means it has not closed below the band. Here you can see that has closed below the band and then closed above the band. So that was the bottoming out again for Nifty. So again it was there. And if you can see again here what has happened is that it's closed. It opened below but closed higher. So the low that's been made, that will act as a very strong support. So technicals that I said is that they can help you significantly enhance the probability of your trading on the right side of the market. Yes, there will be trades which will go wrong, but then for that you should have stop loss. And the most important thing is that don't take a huge loss in any case. You should have your stop loss defined before you enter a trade, so that if the trade goes against you, you take a stop loss and move out and move to the next trade. But if you just hope and cling on to that loss making trade and the loss becomes substantial, then your coming back in the game becomes even more difficult. So we'll take another example. In this case, it's Tech Mahindra. So Tech Mahindra, you can see that it has moved in oversold territory. This 20 period is that we had here one, but it did not close below the band. What we are seeing is throughout the prices are above the 100-day moving average. So overall the trend is up. But here we are seeing in this particular case, they say that was in the first week of December, that prices closed below the lower band and closed above the upper band, and overall trend is positive. Here we have oversold zone slightly, and then this can be a very good buying opportunity. Had you waited for this also, then also you could buy, but these 2-3 indicators itself are sufficient for a buying opportunity. You can see that from 460 levels or so, it's rallied to almost 600 or so. So this can you can use it very well. If you have time on a intraday basis, you can use it on short-term charts, 15-minute, hourly, 30-minute chart. If you don't have that much time, you know, a daily chart, that can be very useful. So the odds against it, this is what I want to just add on, that to succeed in trading, you need both confidence and caution. Just being confident will not help you, and just being cautious will not help you. Because if you become confident but you're not cautious, then one might become arrogant, and one might say that whatever I'm doing, that's the right thing. But that's a deadly trait for traders. But if on the other hand, if someone becomes very cautious and does not have the confidence, then he'll never be able to pull the trigger. So meaning here is that if Tech Mahindra is getting a buying opportunity here, so he should have the guts to go and buy with a stop loss below this. If the stop loss gets triggered, get out of the trade. But at least you've taken a low risk trade, because majority of the people, they will not have the guts to take this trade. So if you want to be in the minority, then you have to learn how to take this trade and take the trade as a game. If you are either you're stopped out or you make money. So in case you're getting stopped out, you lose small amounts of money. But in case you are entering and you can hold on to your position, so you make a lot of money. So for that you can use parabolic SAR. For that you can use 10-period exponential for trailing your profits. So what happens is that you need confidence to say that this stock is going up. My indicators say it will continue to rise, so I'm going to get long and ride this trend. At the same time, you need to be humble enough to put on trades whose size will not endanger your account. You should not trade so heavily. You should not. You should always keep your account size in mind, because if you're over leveraging and you don't know how to manage your leverage, and if the market goes significantly against you, you can lose a huge amount of money. Likewise, you can make a huge amount of money as well, but you have to be cautious. That's what it is. You have to accept the uncertainty of the markets and be ready to take a small loss without quitting. So when you feel a surge of confidence in a new trade, it is hard to think of the downside risk. But if you don't do it, you cannot protect yourself. Because when the market goes against you and hits your predefined exit level, you have to humbly exit, no matter how confident you feel about the trade. You need both confidence and humility. So the ability to be aware of two conflicting feelings at the same time is one of the hallmarks of emotional maturity. So generally, people who are very confident, them being humble is very rare. But if there is someone who's confident at the same time humble, So that person has a very high chance probability of being very successful as a trader, because if you are humble in your trading and overall, that means is that if you're making a mistake, you'll accept your mistake, you'll correct your mistake, and you'll move ahead. So that's the reason the odds are against you. But with the tools and techniques which I've explained to you, both on the trending and the non-trending side, you can do wonders in the market. But it's all a learning. It's all a learning experience. Learning never ends. It's just a beginning, and you can definitely proceed. We have our Angel product, Angel Advanced Charting tool, which is there in Speed Pro application. So those who are using it, that's fine. Those who want to use it, they can write a debroking@angelbooking.com. You mention your client code and you request for activation of Angel Advanced Chart. So that gets activated in your Speed Pro. So it's only available on Speed Pro. So that gets activated on Speed Pro, and you can use it very well. You can plot all the indicators and you can study it. And this is a very good, excellent charting application. So with this, we conclude the webinar. Thank you so much.